I guess you remember a situation with Citibank when UX mistake led for a bank to lose $900 million.
Ultimately, it comes down to a game of trust. And the problem that Citi had was accidentally sending requests of repayment and payouts before they knew that their contract was good. And the other side saying, contract is pretty clear, we don't have to pay you. If there had been long-term relationships between Citi and those beneficiaries, trust would have overruled that and said, I know the contract says this, but we've been banking together for 25 years. You don't want to jeopardize that long-term relationship. One of the coolest launches we did at Uber was, we would know your bank account was saying zero. You cannot afford this transaction. But we'd also know that you'd done 9 trips with us this month and you'd done 2,000 trips with us life to date. So we would actually tell you, hey Yuri, I know your bank says you're short of money. We're going to let you ride on Uber. Please pay us back tomorrow. And that's a risky choice, right? But we knew so much about you as a customer and your propensity to repay us that we could take that risk. The upside was you trusted us so much more when that happened that you'll never go ride on Lyft ever again.
Hello, Peter. Thanks for joining. It's a pleasure having you here. Your work history shows that you are not afraid of very large, ambitious, and complex projects. It's harder to imagine something larger than Google Wallet or Uber Money in fintech's area, especially based on the complexity and risk if it fails. So tell us a bit, what are your problems you're trying to solve now in the industry?
Yeah, well, great to meet you too, Yuri, and thanks for having me on the podcast. Look, I would say what we're trying to do at Synctera is sort of effectively empower the next 10 Google Wallets or Uber Monies. And by building a platform that it makes it easy to build the next Uber Money, we're unlocking the ability for non-big payments team companies like we had at Uber to get into the space. And the best analogy I could give you is 10 years ago, give or take, 15 years ago, I can't remember the founding time of Stripe, Patrick and John had this vision of making it possible for anybody to add payment acquiring with a low friction and a low effort. And at the time, the only way to do it was if you had partnership with Braintree or one of the big payment providers, Adyen and others. And the Stripe team basically made it super easy to add payments. And what happened as a result was tons of innovation. People were creative. Payments started going into different sorts of categories that previously no one thought would make any sense. Subscriptions became supernatural. E-commerce just thrived and flourished really, really quickly. Banking is harder than payments in many ways. And so what we're trying to do is copy that playbook of make it easy as possible to add payments into whatever else you're doing.
Stripe came right in time when SaaS industry and all the cloud products were rising. What changed in the industry now? So this product, like we have the rise of banking as a service, I guess, like in the last few years mostly. What changed in society, in regulations, in technology that now it's a great time for the industry to grow?
I don't think demand for the product has ever slacked off. It's always been there. But it's really been a case of how do you explain the value prop to a small business owner of having a bank account close to where their payment acquiring is? So imagine you're a doctor's office. And right now you probably do your banking with the local Chase branch or Bank of America branch in town in your city. And you probably begrudgingly do that. It's not your first choice, but it is what it works. You got your business corporate account with them. So then you add like a payments webpage and a scheduling billing system, and people say, hey, come online, pay your bills. And you got money coming in probably through Stripe or someone else. And it goes to some other bank and then gets moved over to Bank of America or Chase 24 hours, 48 hours later. But in the meantime, you have to pay for inventory, you have to make payroll, you have to do bill pay, you have to run the business. And the time lag between the money coming in from payment acquiring to being able to spend it becomes, a fundamental flaw of the economics of your business, and you need a ton of working capital to support you. What Shopify and Square showed the market was that if you could be just-in-time financing for that merchant, whether it's buying materials or buying inventory that they could resell, or buying equipment such as a new fridge or a new oven at a restaurant to expand growth and capabilities. You had the opportunity to sell products that are financial in nature to your clients with much higher success rate. What's happening in e-commerce and in vertical SaaS is everybody's seeing that playbook and saying now's the time to start adding banking into whatever else we do.
If we imagine that we move 20 years in the future, how would you think people will describe our era in banking? Like if you compare that to the internet development, are we still in dial-up era, or it's already broadband internet, but maybe still not gigabit level of speed?
Haha, that's a good question. I would say we're just in that broadband transition. So we've come through dial-up, which was basic, issue a card, run the business type of stuff. And now we're going to be 20 years from now with pools of money that are dynamically moving around depending on your need. By analogy, it's a lot like decimalization of the stock market. So prior to decimalization of the stock market, there was all this arbitrage on I did a trade and you sold it to me at 22 and a quarter. And under the covers, the counterparties were selling at pennies or tenths of a penny or hundredths of a penny on the transaction. And so that arbitrage, that gap in price economics, was exploited by the broker dealers as free money. We effectively have that same arbitrage happening right now in lending. It takes, at best, 30 to 60 days to reprice or refi a house. But the reality is the bots, the AIs that we have should be able to do that repricing every day. We don't do that because it's expensive, it's time consuming, it takes a lot of effort and a lot of due diligence. But 20 years from now, the price of economic services will be like water. It'll be fluid, and you don't have to worry about the cost of moving your money around as a discriminator of why you should choose the right bank and the right service. The same thing happened on the internet. Prior to the internet, buying stuff was challenging. We all went to bookstores. And then along came Amazon and said, how about a digital bookstore? And everyone's brains exploded. We used to go to record stores and buy music and CDs and stuff like that. We don't do that anymore unless you want the artifact of something to physically touch, to experience. And we're kind of in that mode for banking right now. I think in the US, I think we've sort of hit a tipping point of more users than not having some digital banking services. And I think that trend is happening globally. I think the premise of a physical storefront for a bank will be gone in 20 years from now, other than to be a meeting place to have fun and hang out and meet your shared customers and stuff like that. And ironically, it's back to the future. So ING pioneered this 20 years ago, 25 years ago with ING Direct, which was a coffee store. And people were thinking you're insane. Why would you want to meet at a coffee store to open a savings account? Turns out they were right. The community aspect of meeting and aggregating is still real. Ultimately, Adam Newman's premise of WeWork, which was a place for like-minded entrepreneurs and founders and stuff to meet and just sort of hang out and get vibe from each other, turns out is correct. Like we Synctera go to WeWork once or twice a week. And it's serendipity. You meet really interesting people, and that is legit.
Can you say that current trend is optimizing of the financial system when we are taking away bottlenecks and places where the financial system can be maybe not competitive enough or not efficient enough?
I would say, generally speaking, the banking system has, in most countries, 5 to 10 incumbent mega banks that have a preponderance of customers. In the US, something like 70% of people bank with the top 10 banks in the US, maybe even higher. And then there's a middle ground, and then there's a long tail of small community banks that are large by volume, as in number of locations and number of brands, but low in terms of density of customers and so forth. And the reason for that is there's a huge utility cost of running a fintech or a bank. And the big banks continue to scale bigger because they can afford to invest billions and billions of dollars every year in technology. Companies like us empower the little banks and the smaller banks and the smaller brands to compete with the big guys on a technology basis. And then it comes down to brand preference and consumer engagement. And yeah, so where we are now is technology is starting and has continued to make make non-technology expensive companies competitive in the market. And that's through optimization, it's through better process, it's through better capabilities over time.
We had similar situation with network protocols. Many years ago, there were like huge players that tried to create their own ecosystems, but at the end, IP protocol and internet won. And in banking, like ideally, you would think that there is a huge opportunity for large banks to build all ecosystems around themselves, but somehow they are not innovative enough with all the products they produce. And startups and other players are moving much faster and providing more value than them. And at the end, it looks like we will end in banking internet where everything is interconnected with different APIs and providing more freedom. Do you agree with that?
I think the interesting thing is in the countries where the central government and or the central banking system has more operating control, you've seen that innovation move quicker. The example would be UPI in India, where the government basically said, we think P2P payments should just be free. We're going to create a standard. And then through the regular RBI, they basically said, you must comply and you can't charge anything. So you had the Googles, the Amazons, the PayPals of the world complying with an ecosystem that cost them money to run, but they had to offer it for free. And that was allowed countries like India or Brazil with PIX to jump over or leap over incumbent players really, really quickly. In markets like the US, where there's multiple regimes of regulatory authority ranging from the Fed and the FDIC to the OCC to the FTC to the CFPB, you name it, there's a state banking authorities in every market. It moves slower because all these different regulators have to agree on a protocol or a standard. The best way to think about it is in the US, there was a company called Early Warning Systems, which was really a way for the big banks to exchange check data at point of sale. So imagine back in the old days, you'd go into the grocery store and you'd pay for your groceries with a paper check. Someone had to take risk on that paper check clearing. And so early warning systems allowed the banks to, in real time, say, hey, do you think this customer is good for this check? Yes, no. That evolved into Zelle, which was a very fast moving consumer P2P service. The Federal Reserve introduced FedNow about a year and a bit ago, and it's growing quite nicely, but it's the open standards version of effectively Zelle. And unlike the Brazil or India, where the federal government and the banking regulator just said, everyone has to comply, you have 60 days, 90 days, be done with it. Here in the US, we've tended to be more market driven. So Fed now has to compete on features and viability to encourage other banks to participate. And that slows the adoption curve, but it makes a stickier adoption curve. Once you're in it for the long haul.
Do you think in the future banks will be more commodified services? Because if you have everything interconnected, do you have similar thing in cellular services? Like people used to use phone numbers to call, now they use them mostly for internet. Yeah. Like, do you think that's a role for banks in the future?
I actually think yes, with one big difference, which is the banks can manage risk. And it's really hard for an aggregator or an orchestrator to manage consumer or interbank risk. And that's the skill of a bank. Ultimately, the bank's goal is raise a bunch of deposits at the lowest possible price. And if the Fed is the place they get their deposits, great. But ideally, they have a cheap source of funds and then turn around and lend those funds out or trade those funds out in different and interesting ways. The best banks will still be really good risk managers. And I think it'll be hard to commoditize risk management. So the arbitrage as a bank of I raise money at 4%, I sell money at 10 or 20%, that skill set gap will still take a long time to commoditize. So the best of the banks will be like the best of the network operators by your analogy. So people pick Verizon because the quality of service works better and that the related ancillary services just sort of fold into the ecosystem well. But functionally, Verizon, AT&T, and T-Mobile, they kind of all work the same. So then it becomes a brand choice. And or when did you get discovery of the product? And product discovery in financial services is moving lower and lower. Ironically, it's back to the future. So when I was a kid, I don't know, I was 5, 6 years old, I got my first passbook. And you want to talk about distributed ledger? The passbook is the perfect distributed ledger. Literally, my bank balance was a line item printed on a piece of paper that said, your bank balance is $110. And every week I'd get $1.15 or whatever it was, my allowance from my parents. It was a long time ago. $1.15 sounds really low now, but it was it felt meaningful at the time. And then I'd spend some money on lunch and snacks, and whatever was left over, I'd walk into a branch and say, I'm depositing 50 cents, 75 cents, a dollar. And I was a young kid, so that felt like learning banking. Today's equivalent of that, the likes of Greenlight and others, bring education of financial services down to 13-year-olds. It's a little bit challenging to go below 13 because of COPPA, which is the Child Online Protection Act. But if availability and early access to bank branding happens at that age, we know that that becomes where you ultimately will keep your money unless you find a really good reason to move it. And so early exposure to banking becomes more and more important over time. And the banks with the longest vertical deep reach will realize that that's their trend line. And then they'll start sponsoring education. They'll start sponsoring products and services that matter to kids. So all the rewards programs that are interesting to you and me, like points on travel and stuff like that. So like I use my American Express card forever. I'm a member since 93, never dropping it, never. Amex people, I love you. Never, don't ever go away. But for kids, they want discounts on Discord, or they want Valorant points or whatever. And understanding the marketing dynamics of that will be the really interesting place where growth happens.
Interesting. There are a lot of people working now on fintech products, or now they don't think that they are in fintech, but they are. Or there is the industry where they can bring some features from fintech, like if they're working on payroll or maybe some management software for the enterprises. There's always an opportunity to bring some integrations with banking. Do you have any framework or recommendation for them to decide if integrating with platforms like yours will bring benefit for them, and how to find and validate ideas that worth checking?
Yeah, so I would say banking is everywhere, and it's not obviously everywhere. One of the biggest banks in the US is Starbucks, and they sit on, I don't even know, $10 billion, $12 billion of cash from consumers, and they don't pay any interest. They sort of pay reward points if you spend with your balance, which is good. They psychologically bamboozle customers, myself included, into maintaining a balance. It literally makes no sense for me to have a balance at Starbucks. I can walk in, I can pay with Google or with Apple Pay or whatever. There is zero friction. And yet I am convinced that I should maintain $100 in my Starbucks account. And whenever it goes below 100, it tops back up to 100.
Mm-hmm.
Completely irrational. Games are the same. Online gaming, one of the coolest scenarios I heard about was EVE Online, which was an old online multiplayer game from Sony, was having inflation, like the price of goods on the product. So if you bought this sword and I sold it to you, the price of the sword would go up faster than the amount of new money being minted in the game. So it was completely illogical. There shouldn't be inflation. Turns out they had people exploiting the game and were injecting fake money into the ecosystem. So more money was coming in than was actually being emitted by the game. And they didn't determine this until they actually ran fintech models of arbitrage of what's happening on the stock exchange inside the game. This is everywhere, in every sort of domain. Every sort of small business needs banking services. Every consumer needs it. And pools of money exist across the world. It's back to the future, ironically, for the PFMs of the world, the Yodleys and the Plaids of others. Because I have so many pools of money that are dedicated for use cases, as long as there's fluidity and I can move money around between those pools of money efficiently and with no cost, I'm going to leave my money everywhere, wherever I get the localized best optimization deal.
Starbucks is definitely a huge corporation, yeah, and like even in US and Canada, I guess they have the same bank that you can spend your coins in 2 countries. For realistically, what is the minimum size of the company that can or should think about integrating with banking as a service for them?
Yeah, so that's really interesting. I think from my perspective, the ideal end state is that banking as a service is like Shopify, meaning anybody with a community of 5 or more people can launch a service that's unique and special to them. We're quite away from there. So our minimum threshold these days, as we talk to customers, is you've got 5 million in the bank, you've got trajectory, you've got good investors, and you've got a compliance team and you know what you're doing.
Mm-hmm.
In reality, that's a small subset of early startups at this point. And so because of a lot of the challenges with compliance and regulatory stuff that's happened over the last 2 or 3 years, the bar has been raised quite high. So what that means is there's a whole bunch of innovators that are finding it really, really tough to come to market because they're $1 million in pre-seed round of 200,000, 500,000, YC invested. And I feel bad about that because I feel like there's a whole bunch of innovation that can't find its way to the market because it's too hard to build and it's too economically expensive. On the flip side, as a provider of the service, our customer base has grown tremendously from these early stage startups to non-fintech Series C, D, E companies that want to add banking to whatever else they're doing. And so that makes it easier for us to find the right ideal partner for our sponsor banks, but it also de-risks the whole ecosystem because bigger players are coming into the market.
Mm-hmm.
So I would say it's, broadly speaking, the bar is much higher than it's ever been. And the incumbent players like us that have created pretty good franchises are able to pick from the best brands that are coming to market and help them come to market. The downside is we're missing out on a whole bunch of creative folks that have great ideas that are earlier in their fundraising journey and finding a way to come to market.
Yeah, but hopefully it will change later. That's for the next few years, hopefully, to change. Do you think it's the same process that now when you go to any supermarket chain, like any malls, they want to give you a credit card? We will have this more in any other type of company. All the employers will give you their own credit cards, all own payment systems. And what do you think about this process?
I do actually. I think there will be one operating system, if you will, for each vertical business operation. So if you're a med spa or a health spa or a nail salon or whatever, there are a number of players like Gloss Genius, Zenoti, MindBody Online that own the scheduling, the spa management, the logistics of your store. All of those folks will add banking as a service to their customer base. It's very natural. And as a store owner, you'll end up once a year or once every 2 years picking between the best deal for you. And the best deal may be better lending terms if you need to buy equipment. It may be faster access to your money. The logic of what you pick and why you pick will be quite different per client. So I think that is definitely going to end up with, if you're a multidisciplinary manager, maybe you own a health spa over here in one city and you own a gym in another city. They're similar, but they're not the same. And the operating system and the needs and the bill pay are different, that you'll end up with two pools of money. As a consumer, that will end up with fractured pools of money. And so then there'll be the argument, is a general purpose player going to be better at it for you? But it's back to the future. Back in the old days, we all used to have store credit. And along came Visa and MasterCard in the 60s and 70s and said, store credit's great, but how about personal credit that you could then extend yourself to any particular store? And it's just a push and pull between pools of money, relationships with individual stores, and the ability for each individual store to take risk. So the pools of credit allowed many more stores to offer credit to their customers because they didn't have to think about would they get paid. Visa and MasterCard and the associated issuing banks solved the payment to the merchant. The cost to the merchant was 2.5% to 3% for a risk-free payment transaction. And we call that interchange these days. Those cost trade-offs become more interesting if you can do pay by bank, where there's limited interchange and the merchant doesn't get to be impacted as much by the issuing bank from a cost perspective. But the consequence of that is you need better technology to make sure that these things all work well.
Regarding technology, one of your podcasts you mentioned that some of the software you worked on is already 30 years old. And for me, it feels like that's a huge enterprise to build the banking software. It should take dozens of years to finalize it. And because of that, we have so much legacy software that is still something that was written in 90s or maybe even earlier. What is your expectation when we will update all this software, and is it even possible to have modern software for banking to recreate everything? At least maybe if everything becomes API based, we will have ability to easier create front ends for that. And because when you go to the bank and you see the lady spends half an hour to fill in the form to open you the bank account, it feels like, wow, why does it has to take half an hour in 2024? Like it can take 5 minutes.
Tech in banking is pretty old. I think tech in travel is probably slightly older, and tech in government is probably oldest. But if you look at the ecosystem, when we started Phoenix back in 93, the premise was everyone were in data centers running on old AS400s or ES9000 IBM mainframes. And back then, there was no cloud, but there were these things called processing data centers. Ironically, cloud computing is back to the future. It's literally just moving what was then distributed out to the clients, bringing it back into the cloud, into the network. When we started Phoenix, those data centers were horribly monolithic and very, very difficult to innovate and to create new functionality. And so we created literally a pizza box, a Sun One server that cost, I don't even remember, $10,000. And you bought it and you bought our software and you had a bank in a box and you were done. You didn't need relationship with Fiserv or FIS or whatever. And that was in this time when Windows PCs were coming up, Unix was coming along, the internet came along. When we first launched, like we couldn't even maintain these servers. So we actually had dial-up modems that literally were sat on top of the Unix box that was sitting inside the bank's data center. And we'd dial into the data center and do command line prompts. It was pretty old school. Internet comes along, makes the communication traffic and all of that stuff become much, much easier. But technology in this space, the fundamental building blocks, ledgering and that sort of stuff, doesn't really change that much. There's only so many ways you can do dual entry bookkeeping. And banking sort of sits on top of that. You can thank the Medicis of the 14th century for creating accounting. And since then, those systems at the very root of the banking infrastructure have changed infrequently or not at all. Like, as much as I think and admire the thought machines exercise at JP Morgan Chase, it feels unfathomable that they're ever going to change the core banking system of Chase. Same thing with B of A. But what can happen and where the innovation is the layers saying, leave that stuff alone. We'll treat it as the most basic building block. Think of it like your IP constraint of the internet. And we'll layer on top of it functionality and capabilities. And if we really, really, really have to, we might change a component at the core. But let's see how we can layer over the top of it and leave the core as it is, because it's really, really hard to change. I think it's very hard to imagine net new players fundamentally resupplanting all of that infrastructure. It's just too ingrained, too big.
I guess you remember a situation with Citibank when UX mistake or maybe inefficiencies led for bank to lose $900 million. They sent to their clients and then lost hundreds of millions. I guess they had to just say that, okay, this lost. So what are your thoughts on that? Like, you're also in a risk industry, and some mistakes that your users or maybe users inside of the client can make can cost millions of dollars. What should be changed in the process of software development to avoid this type of mistakes? Because I guess it's the most costly mistake that ever happens. That fault may be lying partially, at least, on people who develop the software.
I think the hard part about banking is ultimately it comes down to a game of trust. Technology notwithstanding, does Peter say, I want to loan money to you, Yuri? And do I believe you, Yuri, are going to pay me back? That's it. And you can create all of this technology to write down the rules by which that trust is generated and enforce the trust dynamics of, hey, you owe us $10,000 every month or whatever to pay off your loan. But when all of those systems work or don't work well together, at the end of the day, two humans are still saying, hey, we screwed up. We trust each other, right? Make me whole. And we have contracts to buttress that trust dynamic. And the problem that Citi had was accidentally sending requests of repayment and payouts before they knew that their contract was good. And the other side saying, contract is pretty clear. We don't have to pay you. If there had been long-term relationships between Citi and those beneficiaries, trust would have overruled that and said, I know the contract says this, but we've been banking together for 25 years. You don't want to jeopardize that long-term relationship. And we have contracts to deal with and anticipate those sort of edge cases where trust falls apart. In technology, what we seek to do is build a way of codifying that trust into words and systems and processes. And invariably, we try and layer in on top of that somebody who's reviewing the trust enforcement or the relationship dynamics. It's impossible to cater for every scenario. And so there's a tipping point between how much time do I spend validating that the system works versus getting into market and testing that the system works. It's pretty clear in this case, or in the Citi case, that they had encoded into their contract stuff that was not easy to foresee or to implement properly in tech. And they ended up committing themselves to an action that got them in trouble and they couldn't undo and unwind. This happens in every sort of technology. That's why, Google offers 10 to 60 seconds of undo on Gmail now. Everyone used to think, oh, it's amazing, I can send email in real time. And then everyone was like, oh shit, I need to pull that email back. How do I do it?
For me as a designer, when I see the interface, and it's super clear that like 20 years ago, there was a book about heuristics, and like it breaks every rule possible about how would you design this type of system to make it much harder to make mistake. So people who build this, they just didn't care about reading this book, or they just didn't care to have designers on that. Only it was built only by developers. I don't know. Maybe they were in rush, or process was like that, or buying persona didn't care about usability for the end users. So I still think like the problem for business software is that nobody cares too much about experience and learnings of the software for end users. And now the change that there are much more, like many players that can build much better software on the layer of the banking that maybe it's not so good with so good user experience. There is a very nice chance to compete also on user experience of the banking software, not only about, okay, this is transactional. Yeah, but it's like we were used to use software that just did it work, but now we want to have the software that helps us to do the job easily and that we enjoy it and move forward.
I think that's right. I think, the functional utility of software in banking is pretty understood at this point. People know how to move money from here to there. What is the opportunity is for people to orchestrate that money movement for more interesting reasons or purposes, or to save the customer money, or to earn more interest, or to pay less fees, and so on. And doing that in an elegant way will always trump doing it in a poor way. The sort of adverse outcome of that is Goldman Sachs went into a deal with Apple on the Apple Card thinking they're going to get a whole bunch of customers that revolve on credit. And as a bank, you want revolving credit. That's great. That's what banks do. Goldman's a risk manager. Apple, in turn, built the most beautiful app that made it almost impossible to get into debt. So by default, you paid everything off in full. If you didn't want to pay it off in full, it had negative user interactions. It got redder as you said, no, I'm going to pay less. I'm going to pay less. I'm going to pay less. So they were encouraging what they believed to be the right behavior for the consumer, which was try not to use credit if you don't have to. And so you had these out of aligned goals. The bank saying, give me more credit. Apple working on behalf of the consumer saying less credit. And then you ended up in this fundamental misbalance or imbalance of business product dynamics. I think from the consumer's perspective, Apple was clearly right. Less credit is good, but it also creates a weird behavior, which is you have access to a consumer group that probably actually needs credit, but you haven't attached a good way for them to get it. And so user experience and design has a huge impact on how to approach that problem. And as buyers of technology, consumers, we're kind of lazy. We kind of go where our access points are. So I'm sure Apple got a ton of customers just because people used Apple Pay all day. And suddenly there was a card that came from Apple. You're like, sure, I'll take that. That sounds great. And they approached it from an experience perspective and a business operational perspective, meaning least amount of friction while making sure they made good compliance decisions on not banking the wrong person. Those things are sometimes at conflict with each other. So as the designer, you want the least amount of friction as possible. But as bankers, we've got like all of these checks and balances. Do you understand the disclosures? Do you know you can't shop in Iraq or Iran or whatever? And those things are hard to navigate. The best banks, the best online experiences blend consumer behavior with outcome. And the best example of that was Uber with payments. So prior to Uber, what was the shopping experience? You got into a taxi. If you were lucky, the taxi driver had change. Most of the time, they pretended like they didn't. So you got it kind of screwed on a tip. You probably didn't even have cash. So you had this inconvenient experience of walking up to an ATM before you could get in the taxi in the first place. And if you wanted to pay by credit card, the taxi driver would say, no, I don't take credit cards, even if they did. And if they did say credit cards, they'd charge you some exorbitant fee, $5, $10 just to do the credit card. And at Uber, what we did was we basically said, throw that on its head, get a card on file, treat it like your card on file at Amazon or at Google or whatever. And the buying experience is really just get in, get out. And what that meant was the open rate on emails for your receipt was really, really high. So we had this unintended consequence, which was at the end of every trip, we'd send this receipt. And it was extraordinary. People were always looking at it, double checking the fees and stuff like that. But no one slowed down their movement. And so the behavioral shift from end of trip, arbitrage, negotiation, how much cash am I paying, all went to zero, and growth was phenomenal. The interesting thing was, from the driver's perspective, they wanted the cash because it was real-time access to money. And waiting to the end of the week to get paid was friction that they disliked. And so there's always different constituents. And the obvious buyer of the service is not necessarily the person in session. It could be the provider of the service. And you don't even realize that until you really understand the complicated dynamics of a payment ecosystem.
And also what I liked is how refund was done. Very, very easy, very convenient, that it's built loyalty, because there is no need to call anybody. There is no need to write long messages or something, that it just works.
Building trust in every ecosystem is super important. One of the coolest launches we did at Uber was, we would know your bank account was saying zero. You cannot afford this transaction. But we'd also know that you'd done 9 trips with us this month, and you'd done 2,000 trips with us life to date, and you're probably going to want to keep riding on Uber. So we would actually tell you, hey, Yuri, I know your bank says you're short of money. We're going to let you ride on Uber. Please pay us back tomorrow. And that's a risky choice, right? It's like being the store owner and saying, hey, I know you need your groceries. I'll let you take the groceries. Can you come back tomorrow and just pay me up the rest? But we knew so much about you as a customer and your propensity to repay us that we could take that risk. The upside was you trusted us so much more when that happened that you'll never go ride on Lyft ever again. And building trust and loyalty in payments and in the banking ecosystem is such a high valued thing that you can't measure it almost.
Awesome. So Peter, if you would start your career now, if you're like in your 20s and without all the experience and network you have, but you would want to build another cool product, what would you focus on? What would you recommend for such people who are starting fintech products or working on them?
So right now today, I think automation of consumer money movement is the thing. When I started working at Yodlee, we had like the best online scraping data integration, so we could see your balance everywhere. And the thing we knew was just being able to view your money was really interesting, but being able to move your money and move money around and optimize it was where the money was at, which is why we built funds transfer, bill pay, and all these other services as well. It's ever more important now as people's pools of money are everywhere. And so a really interesting problem to go solve is what I'll call the continuously repricing checking account. So literally, every morning, looking at the best interest rate, moving all my money over there, getting a day's worth of interest, and then moving it to the next bank, while also knowing that I have all these auto pays that have to get satisfied somehow, and not making sure that I overdraft any particular account. And that's hard to do. And it requires a lot of really interesting IP to think about where's the money going to go and why do you need it and all of that stuff, and predicting and forecasting. But getting that right will be hugely valuable to consumers. And the same sort of thing on the lending side. Move my car loan around to the best price every night. And there'll be all this friction where the other bots on the other side are saying, I'm not going to share the information with you. So there'll be a bit of cat and mouse that needs to happen. And the best AIs will win that trade.
What about B2B area? It's similar, or?
B2B has this model in spades. So counterparty risk, funds flow, my suppliers pay me slowly. How can I get money in an interim? That sort of stuff is super interesting. Speed of money is ultimately the game, and 24/7 access to being able to move money. The big change that's happening at the Fed, I think in February or March timeframe, is the Fed's moving to 22/7 on wires. People's brains are going to explode when you can do a wire every day of the week, other than 11 a.m. to 1 a.m. There are so many use cases. The price of a wire will drop precipitously, and money flow will move in a much more interesting way. As long as that can continue to scale, I think we have a lot of opportunity. I think the other thing that's really interesting is the world has become ever smaller. COVID broke down the barriers of who can work where and for whom, and yet earning is local. So if you're a great engineer living in Ukraine and you want to work for a US company, the friction you feel for that is less about can you get the job because you know you've got the talent, but it's more about how do you get paid and how do you make sure you keep the money safe and secure. 5 years ago, that wasn't even a consideration. If you're a team in the Ukraine, maybe did a corporate relationship with a company, but as an individual, you couldn't, or you would move. And now you don't have to move, which is really fantastic. Banking hasn't caught up with that phenomena, and you still have pools of money that sit in the US, pools of money that sit in the Ukraine, and making it easy to move money globally is really important. And the thing that's blowing up most of that is global identity. So the world sort of revolves around UN standards for many things, and a global identity standard doesn't exist yet. When it does, that will unblock a whole bunch of trust in the ecosystem that is yet to be solved.
There is also a question of regulation and taxes, I guess, the problem. How do you taxate the money when people can live in any country and you will need to integrate all this information there? Yeah, but I agree. We had a lot of clients coming to us in fintech area and saying like, you just imagine what the problem you want to solve. Like you can pay almost immediately with crypto or something like that. Would say, I just paid salary for all my team, and in second after I clicked send, all the SMS around the office came out that they already had their money. So in the younger countries, I guess innovation is much faster. So what you are saying that will happen in US, we have for decades or longer in Europe, when it's immediate. I could open bank accounts, 4 bank accounts when war started and I was abroad. So there was no need for me even to go to the bank. I did it from my phone in 5 minutes. Yeah. So we are living in an interesting time. We are almost out of time. So I have a few rapid round questions for you. And if you have a few more minutes, we can finish. Yeah. Okay, Peter, how would you explain to your mom what you're doing for a living?
I explained to my mom, we make it possible for people that are not banks to be banks. So my mom goes to Woolworths, which is the local grocery store in Australia, and I make it possible for her to have a wallet at Woolworths so she can buy her groceries and not have to think about it.
Nice. What book influenced your product vision the most?
Yeah, so a really interesting book by Dr. Russell Ackoff, who used to be a professor of systems thinking at Wharton, is literally called Systems Thinking. And it changed my philosophy on trying to optimize any one thing to thinking about ecosystems and how the pattern of the whole ecosystem makes a big difference rather than proving this thing is right. And I was very lucky to have a session with him when I was doing my MBA. And he had this great phrase: doing the wrong things better isn't actually good.
Yeah.
And when you think about it, you're like, hang on, I've just optimized the wrong thing. It's really good, like we're the best at doing the wrong thing, but if you did the right thing poorly, it's still better than the wrong thing well.
Yeah. What product gave you the best experience ever?
I think the PlayStation 3 was one of the coolest products that ever came out and brought technology into the house and undid all of the nerds sat in their bedrooms by themselves. And it brought music, it brought video, and it was the product where long-term vision worked. Like the BOM on that device was $700 and it was sold for $499. So they were losing $300 or $200 on every device. But they had this long vision of, we know it's great, it'll just take time, commoditization, and change the world. PlayStation 3 was an awesome product.
What part of your job motivates you the most and keeps you enjoying what you're doing?
Oh, it's super clear. It's the team. So I love building great teams and getting them to be better than they think they can be. And we can always build cooler products and stuff like that, but building a great team is by far the most exhilarating and fun thing to do.
If you could have a dinner party with the most influential person in product design or product development, who would be this person, alive or not alive? And why?
I mean, the easy one is Steve Jobs. I think his vision on product design was off the charts. The not obvious one would be Bill Gates, who actually changed the world in so many different ways, and we don't really perceive all of his change.
What's the most valuable lesson that you learned in your career?
Making small mistakes isn't that interesting, and making big mistakes and learning from them, awesome. But it means that you tried really hard and did something really interesting. But being riskless doesn't get you anywhere.
That's my favorite quote. Yeah, I really love it. Thank you, Peter. Maybe you would want to discuss anything else we missed today?
No, I really enjoyed our conversation, Yuri, and I hope this resonates with your listeners. And obviously, if anybody wants to reach out to me, I'm all over LinkedIn, Twitter, all that sort of stuff. Or you can just email me, p@synctera.com. Super easy.
Awesome. I think there are a lot of possibilities for cooperation with you based on like different fintech startups. So you are like in the middle of ecosystem, and there are potentially thousands of companies that can work with you, and hopefully they will find success together.